Welcome to the second session today of the Global Economic Zones Expo and Convention. This panel will focus on tax incentives in economic zones. Allow me to welcome on stage the chairperson, Shri Sumit Dutt Majumder, former chairman, Central Board of Excise and Customs, author, columnist, and customs and GST expert, India. Kindly a round of applause, please. Thank you. I'd now like to call upon our speakers. Shri Senthil Nathan S., IRS, Deputy Secretary, Ministry of Commerce and Industry, Government of India. A round of applause, please, ladies and gentlemen. Mr. Rajiv Chugh, Partner and National Leader, Policy, Advisory and Specialty Services, EY, India. Let's welcome Mr. Mark O'Connell, CEO, OCO Global, UK. A round of applause for Mr. Bimal Jain, Executive Director, A to Z Taxcorp, LLP, India. And our final speaker, Mr. Baskar K., Senior Director, Deloitte, India. I now hand over the session to our chair, Mr. Majumder.
Distinguished speakers in the dais and the distinguished audience. Today we'll be dealing with a subject which is very topical and very important for the country's development, particularly in respect of earning of foreign exchange and many other related matters. Now, in this session, we have, particularly, I know, when this session, about this session I was informed, a few thoughts came to my mind. I'll just share with you very briefly. I think of late, the Indian exports are facing certain challenges and are not doing as good as we have been expecting. There are many reasons, many factors, but one factor is where we can help the export trade is in respect of taxation. As you all know, internationally, taxes are never exported, meaning you export goods, you export services, but the taxes which are associated with those goods or services, they're never taxed and not loaded to the value of the goods. So it has been the endeavor all over the world to somehow help the exporters in different ways. There are certain limitations with regard to the WTO rules also in this regard. That's why there is subsidy and other things. But on taxation, there is no problem at all, so one can take care of it. Now, there are two parts of it. One is the tax per se, and the idea is that whatever tax it has suffered in the course of its production and at the point of on board the vessel, these taxes must be refunded back to, or go back. Either you don't pay tax or you refund it. That's the idea. And there are various ways of doing it. There are some ways in which pre-GST days it was being done. But I must say, having been involved at the preparatory days in the Central Board of Excise and Customs, a lot of activities were there in 2009, 2011 when I was there. And I would say that always in all our discussions and negotiations with the state government, because as you know, GST is a product of center and states, joint negotiations. One point was always there in the back of our mind is that whatever facilities were available before GST implementation, all these facilities should be there. Rather, we should do better to see to the burden, the compliance burden. Because unless the compliance burden is reduced, because ultimately compliance burden goes into the cost of the goods, and that jacks up the price, export price. And that's make it less competitive in the international world. So All these issues are there. I will first, so today in the scheme, we have some distinguished speakers. They are all domain experts. And I will, first of all, introduce them very briefly. And I welcome them. They're here, sparing their valuable time. We have with us Mr. Senthil Nathan, who is the Deputy Secretary, Ministry of Commerce and Industry. He is from the government. Others, we are not from the government. So what I propose is that Mr. Senthil Nathan will talk last, so that whatever issues are raised, we'll get some clarity from him, because I happen to know him from the days I was in service, and he's a man of action. He is very decisive. So Mr. Senthil Nathan will come last. Then we have a guest from UK, Mr. Mark Cornell, if I have pronounced it correctly. He's the CEO of OCO Global in UK. He will give an international flavor about the export promotions and the special economic zone functioning. We'll have that experience from him. Then we have Mr. Rajiv Chugh, partner and leader, regulatory practice, Ernst & Young, E&Y, India. Then my old friend, Mr. Bimal Jain, many of sessions we have done together, is the Executive Director, A to Z Taxcorp, LLP, India. Then finally, Mr. K. Baskar, Senior Director, Deloitte, India. He's based in Bangalore. So we'll have all those distinguished speakers, and I'll just tell you in short what are the main topics that they will touch. One of the main topics would be key indirect tax benefits under GST and foreign trade policy 2015-20. Then the next issue will be export-related income tax benefits. I suppose Mr. Rajiv Chugh will talk on that in detail. Then impact of GST on SEZ, that is very good, and already Mr. Baskar has made a presentation. I've gone through it very nicely. He has said that what are the positive impact and what are the negative impact. But the negative impact, if I have understood correctly from his presentation, you will see it, it's basically on the compliance part, and where it is always work in progress. There's always scope for improving based on the feedback from the actual persons who handle these things. And so that's very important. Then we have concerns on certain specific issues, like valuation of related party transaction. That's an issue even in customs from ages. Then sales return and purchase return in case of return of goods to SEZ. What happens, how to handle this? Then the distribution of credit, input tax credit, to SEZ by input services distributors, ISD. This was to facilitate the people that you have different branches, and so how do you allocate the credit? So input service distributors. So there are certain, again, I would say the compliance problem with the SEZs. Then there is, of course, RCM liabilities. A lot of clarification has come of late. You know that reverse charge mechanism, that when you are buying something from the unregistered supplier, then you have to be the recipient also. You have to take the responsibility of paying the tax. Generally, always it is the supplier who pays the tax. And the refunds on zero rating of supplies to SEZ. That is another area of concern. Where I have gone to different parts of the country, and these are of the topics which come up very often. As you know, zero-rated, there is always certain issues there. The zero-rated means as against exempted goods. Exempted goods, the final product due tax is exempted, but the inputs which had come and out of which the goods have been manufactured, on that the tax remains, because the idea is that at some point tax has to be paid. But exports are zero-rated because these are not to be consumed in the country. So that means not only you are exempted from paying the tax on the final stage, but also the inputs that you have used which have suffered tax, that also should be either refunded or allowed to be adjusted with your credit account. So these are the main issues. And yes, of course, Mr. Chugh will also deal with, from his presentation, on the alignment of manpower and advanced ruling issues in SEZ, particularly Mr. Bimal Jain. I know he has been talking on this subject, not only for SEZ, for all together, but today I think he's considered on export and SEZ. So all the distinguished panelists have worked hard in preparing very detailed PowerPoint slides on the relevant issues. However, as we are aware, because of limitation of time, which is about 7 minutes or so, 5 to 7 minutes, can extend to 10 minutes. I would request you to run through some of the slides which you can, and then take up the critical ones where some explanation is needed. And for the audience, distinguished audience, there will be a question-answer session at last. So, but in between, please, if you have any question, keep it in your mind or note it down, and please wait for the question and answer session. So over to the distinguished speakers now. I will start with Mr. K. Baskar, because particularly I have seen his presentation. He gives an overall view of the issues that we are facing. Then Mr. Cornell will be speaking on the subject he has come to talk on. And then Mr. Rajiv Chugh, and finally Mr. Bimal Jain. And then we'll request Mr. Senthil Nathan to respond to some of the issues which have been raised in the presentations. Thank you very much. We expect a very good session, and your interaction, your question answers also will be highly welcome. Thank you.
Thank you, sir, for the wonderful introduction. I come from Bangalore, and when I was just reading this newspaper this morning, I was pleasantly surprised. Bangalore is that way very notorious for the traffic jams, yeah? But I could see Bangalore is #1 super city in Tolan study, yeah? And India is standing #1 in digital India, and Bangalore stands first amongst various others provinces or the states. And the entire digitization or the innovation is happening in one or the other SEZs in India. Just to start on this note, most of the innovations happen in SEZ, yeah? So just to set the context, what I'm just going to do is maybe you already know in terms of what are the duty benefits from an SEZ perspective, but I thought I should just set the context in terms of very high level in terms of the SEZs. And what are the SEZ obligations? Generally, when we just go and prefer an application, we get a license on a single window basis. But I would also request you to just keep the SEZ obligations which a unit or a developer has to fulfill during the journey of the SEZ. And of course, certain key statistics which I'm not going to broach. I understand Rajiv has a detailed slide on it. I will pass that for Rajiv. But in terms of the SEZ, as you all know, it's supposed to be deemed to be a foreign territory. Any goods or services coming into SEZ should not be subject to tax. And if the goods or services are getting exported out of the SEZ and to a place outside the country, it is broadly zero rated. And one of the things which I wanted to mention in terms of the SEZ obligations are, many a times we go prefer an application, there are challenges with respect to meeting the net foreign exchange obligations. And basis the recent rules, changes in the rules, now going forward, whenever you're going for a renewal of a particular LOA or an application, the government is going to just check what is the actual NFE and also what is the employment which is generated. So one has to keep in mind, you need to be very robust, very concrete in terms of the NFE obligation, and that is the fundamental. And the NFE obligation criteria is seen over a period of 5 years, and consecutively, if you just make some default in first 3 years, you are put under the watch list. So I thought I should just let this know. So the key tax benefits for SEZs from an SEZ perspective is, as Mr. Majumder mentioned, any supplies to SEZ unit or the developer should qualify for a zero rating. Yeah, and the supplies by the vendors to the SEZ authority, to SEZ the unit or the developer is zero rated, which means they do not have to pay tax. All that they need to do is just execute an undertaking with the government local authority and start supplying services or goods. The suppliers, if they have some input tax credit accumulated, they can go and claim a refund. And those inputs, if it is attributable to supplies to SEZ, even that is available as refund. From an FTP perspective, the SEZ units are entitled to claim what we call the services exports from India scheme. And the percentage of scrip you get varies from one service to the other services. It could be 5%, and recently it has been hiked to 7%. A word of caution, only SEZs are allowed. STPAs providing any services, notified services, are blocked from getting these ACI scripts. And this is one of the added advantage of anybody setting up an NSEZ. And of course, MEI script is also available for the goods. And again, it is in the range of 5 to 7, depending upon the goods which you manufacture and export, and also the country to which you export. And as you may be aware, this duty scripts is tradable, and you can use this to just pay off your customs duty. I thought I should just bring it to your notice. This slide focuses on the GST positives. It's close to 2 years now that we have this GST, and one of the big advantages from a GST perspective is there is close to zero reporting in terms of SEZs, very, very minimal disclosures. And the big advantage, since I come from Bangalore, where 98 out of 100 companies were claiming refund on the input taxes. If a unit is set up in STPI, they need to just pay taxes to the vendors and go and stand in the queue for claiming refunds. But from an SEZ perspective, this is completely changed. Yeah, the vendor has the choice of not charging the SEZ unit any taxes, or even if he charges, you give a disclaimer being an SEZ unit saying that you're not going to take the credit or not going to claim any refund, and it's vendor's headache to just go and claim a refund. Yeah, so the burden on the SEZ, it's come down drastically. And I have seen when the IT services came into effect from 16/5/2008, people started getting refunds only from 2015, 2016 onwards. But from an SEZ perspective, if you just go and ask any client in SEZ, they are saying that we do not have any refund due from the government because everybody is exploiting the exemption benefit. One of the things which I wanted to just, other benefit which I wanted to bring it to your notice is, there is no GST liability for the goods or services getting consumed in the SEZ. So this provides a very good edge over the STPA or DTA. And also there is an IGST exemption towards imports of goods or services. This is something which, these are some key positives. And there are some negatives, and as Mr. Majumder did mention, this could be procedural in nature, but this is very, very painful. I'll just touch upon few points very quickly. One, if you just remember, SEZs are supposed to be zero rated, which means if they are exporting services or goods, they should not incur any tax cost towards inputs. Yeah. However, if you just look at the recent advance rulings, and there are some bit of subjectivity in terms of the authority saying these services, whether it is used for authorized operations or otherwise. So we would request there should be enough clarity to the trade and industry to say, these is the guidelines to say whether any particular input services should be used for authorized operations or otherwise. There is a lot of confusion. I'll just, on a use case basis, I'll just show you one of the advanced rulings. Maybe you will appreciate this better. The second pain point is, although I did mention the SEZ units can just buy the services or goods without payment of indirect taxes, but there is an obligation which the SEZ units or the developer should fulfill, and that obligation is an endorsement of the invoices by the specified officer, and the SEZ unit or the developer is obligated to provide the endorsed copy of the invoices to the vendors. Maybe there is a lot of documentation which is piling up with the specified officer, or there is lack of understanding in terms of what is relevant for authorized operations. Or the third category of problem statement is somebody is asking us to, you please prove that these services have been in fact consumed within the SEZ. So we wanted some kind of a trade facilitation circular, and also there should be some timeline to be put to the specified officer in endorsing a particular invoice. And one other use case which we have come across is some of the cases the specified officer feels that this is not in relation to authorized operations, or he doesn't want to endorse. We also wanted a system in place to say if a particular specified officer differs in our view, whether there can be an endorsement so that the vendors have a right of remedy in claiming a refund, sir. This compliance requirements, this is a pain point for SEZs and others. There is no centralized GST registration. If you have one STPA unit, or if you have one DTA unit and you have another SEZ unit, you need to have two different registrations, one for the SEZ and one for the non-SEZ. And it is not very, very clear whether multiple units in the same states or multiple units in the same state but different zones should need to have a separate registrations. Everybody is taking a view. A very clear clarification would be helpful. One of the pain points, again from a foreign exchange realization for DTA services, if you just look at the SEZ Act, the services definition says that you need to just recover the money in convertible foreign exchange. Also, parallelly, there is no bar for the SEZ units to just sell something domestically. And if you sell domestically, say for a service, you charge in INR and you recover money. But that is against the definition provided in the SEZ Act. Maybe as a practice, people are doing it. Some clarity or some comfort should be provided. And just very quickly, in the interest of time, one other frequent change, which is a welcome measure, there was some confusion in between for the work from home. I'll just touch upon it. Since the ITS crowd, they always feel that they need to be working from home. There were certain conditions which was prescribed. Now it has been taken away. So as long as you have a secured connection between the individual using the individual accessing the server and exporting the services from the SEZ unit or the service located in the SEZ unit, it is a welcome measure. There's a work from home which is liberalized, which is a very good one. And the other point which I wanted to mention is there's a new compliance requirement, which is filing of service export reporting form. This is in addition to the softwares. You need to file this within 10th of the subsequent month. These are one of the changes. And very quickly, I did mention correlating back to my statement. These are the two advanced rulings. And this is what it is not in good taste of the industry. In matter of Cafe Day Global Limited, the Cafe Day was supplying the coffee vending machines. The authority said it has nothing to do with the authorized operations. So one can argue that everything what is consumed or what is procured for the SEZ is in connection with the authorized operations, but the government feels otherwise. So there should be some clarity in terms of what is required for authorized operation, whether the government would decide or the unit would decide. And second thing, in terms of the Govt infrastructure, the employees of the SEZ units have stayed in an hotel accommodation. And if you just look at the SEZ provisions or the GST provisions, any services provided to SEZ should be treated as interstate IGST should be levied. And this hotel refused to levy IGST. And the advance ruling said, since the services are not consumed within the SEZ, what the hotelier is doing is correct. So this is something which we wanted some clarity from the government. This is one of the issues. People travel all over the place, stay in the accommodation. They should recover taxes. Going by the ethos of what Mr. Majumder did mention, none of the services should be, none of the taxes should be sticking onto the exporter. Yeah. So lastly, last 30 seconds. Initially, there was no clarity in terms of whether SEZ can get an exemption from domestic reverse charge. By virtue of a TRU letter, as mentioned by Mr. Majumder, it's a welcome measure. And again, very, very quickly, just to bring to your notice, there is some bit of a pain in terms of related party transaction, especially in the IT or the ITES sector. Anything which you do with the employee and the employer and employee are treated to be related party, that comes with a huge burden of the compliance and demonstrate that you're dealing at arm's length. That is something which we have done. And the distribution of credit by the ISD to SEZ unit, in most of the cases, the credit lies idle with the SEZ unit. Although the portal enables the SEZ unit to claim refund, but I think there is some anomaly in the definition of deemed exports. maybe some clarification should be better. So with this, I end my discussion. Thank you.
Mr. Only, please, over to you.
Good afternoon, ladies and gentlemen. My name is Mark O'Connell. I'm Chief Executive of OCO Global. I'm joined this afternoon by my Indian colleague, Nitin Pangam, who's in the second row here, who looks after our interests in India. Someone introduced me as being from the UK. It's correct that I have a business in the UK, but I'm actually from Ireland. And why that's relevant is that Ireland, for the last, 40 years plus, has built a reputation as having a low tax economy, low corporate tax in particular, and as a consequence has attracted the who's who, particularly of the US, Fortune 500, in medtech, ICT, and advanced manufacturing. And the effective global tax rate, or the rack rate global tax rate in Ireland is 10%, the corporate tax, which has just risen to 12.5%. There's considerable pressure from the European Union to achieve a parity with the sort of high teens, low 20s that most of the rest of the European neighbours offer. But at this point in time, Ireland is resisting those pressures because, we've certainly been on to a good thing in terms of the competitive environment. Now, let me say a word or two about OCO Global. I don't pretend to compete with my esteemed colleagues on the panel in terms of expertise on Indian SEZs and the various tax advantages that may prevail, especially with some of the legislative updates. I definitely won't compete on that platform. But what I have a perspective on is the drivers and motives of global investors. So my firm is about 100 staff represented in 7 or 8 key markets, key source markets for foreign investment. And we're in contact day and daily with lots of internationally expanding companies. So we definitely would consider ourselves having a finger on the pulse in terms of outward or overseas investment advisory. Now, it may sort of disappoint some of my tax colleagues if I say that, in the top sort of 3 motives that we're hearing for foreign investment today, or business expansion today, tax is no longer. It was certainly front and center, but it has been relegated a little because there's a couple of contextual points here. First of all, I mean, globally, and I'm sure the colleagues from Deloitte and EY would hopefully confirm this, most nations recognize that to improve competitiveness, they have to work on improving the sort of tax rates, corporate tax rates, and in some cases, personal tax rates, and tax incentives and clawbacks. And no bigger example, perhaps, than the Trump administration's reduction of the US corporate tax to 21%, effective from January 19. And we're already seeing quite a lot of capital repatriation from US corporations that would be sheltering in places like Ireland and overseas to bringing back capital. Moreover, we're seeing a dampening of outward investment from the US by US corporations because it's pretty attractive to stay at home. The economic fundamentals of the US have been pretty resilient in terms of GDP growth and almost full employment. So, and combined with a more competitive tax rate, they don't necessarily have the motive to establish overseas anymore or protect profits offshore. Equally, I mean, and you'll probably be dizzy and confused, as we all are, with the Brexit debate in the UK. And part of that is about having the ability to break free of the European trading bloc and lower taxes. They're currently pretty competitive in the UK at they're 19. They're 19 today, and there's an ambition to get them down to about 17%. So, and I can talk about the Netherlands, where the effective tax rate is in the high teens. It's either 15 or 17. If anyone's very interested in these countries, I'll get you the precise answers. But really what I'm trying to say is, relative to India, Europe and the UK are much more competitive from a corporate tax point of view. And in fact, we see a pattern of Indian corporations establishing in Europe. So you're losing business, domestic business, to the West from a tax planning perspective, which is probably bad news for India, but good news if India is building global corporations that have these problems. I'll just go on to say that what are the drivers today of our client decisions to invest overseas? Well, clearly, the first and foremost has always been market growth. I mean, if you're not in a dynamic and thriving economy, the chances are that you won't be making much profits, and therefore the tax rate may not be that material to your decision. And what we're seeing today, and in the 20 years I've been working as an advisor to international business, whereas when I got started, I would say, 7 out of 10 international deals or international expansions were in the manufacturing space. Big players that you'll have heard of, like Motorola and GE and VW Group or Volkswagen. These were the sort of the key drivers of foreign investment internationally. Today, though, that situation has flipped around. I would say 1 in 7 projects is now manufacturing, and the other 80% plus, is in tech and services. I mean, that's good news for India because you have a very, very strong and compelling offer, both in tech and services. And interestingly, many of those companies enjoy very little or have extremely low or almost zero effective tax rates because it's particularly challenging for regulators to track global digital commerce or imposed tariffs at the ports and of entry in the digital economy. So those companies are not driven by tax at all. In fact, they're driven by one thing, which you can probably guess, is access to skills and talent. Again, India has a very good story to tell, but I think you're leading on the wrong message. Perhaps for the domestic market, competitive tax is a good message, but what global tech and business services investors are driven and interested primarily in is access to skills and obviously a growing and dynamic marketplace. And for me, that's got to be the focus of the investment promotion effort, above and beyond the fact that we are building a more competitive tax and ease of doing business environment. So, as I say, India, has enjoyed real success in attracting investment internationally, and the job of SEZs, Indian regions and cities, and the national government has primarily been about facilitation. Companies wanted to establish in India because the costs were extremely low, the labour was abundant, and the internal market was highly significant, and it's a good staging post to serve other parts of the world thanks to language and time zone issues. Tax, didn't feature in a lot of those decisions because they were cost-driven decisions. The money was not being made in India. I think India is going to have to evolve as it becomes, a more developed economy, and to do that, there's got to be a doubling down, I would say, on things like infrastructure, talent, and the business environment. Notwithstanding tax as part of that, and particularly personal tax comes into play when you're trying to attract and retain, talented knowledge executives. The other point to make, and this is something that's presenting a challenge for special economic zones around the world, increasingly, foreign investment is dominated by cities because talent lives in cities and technology and infrastructure lives in cities. So most of the investment decisions that we're working with today are driven to cities, global cities, that can offer the infrastructure, connectivity, talent pool, and competitive offers, both from a location and real estate point of view, that global services and tech companies demand. I was with the people from Maharashtra, I'm still working on this, Maharashtra region a couple of days ago, and I mean, their economic policy just launched, their industrial policy is around AI, Industry 4.0, medtech, and autonomous vehicles. Now, guess what? The driver of all of those industries is technology, it's access to skills, and infrastructure, both digital and physical. I mean, tax doesn't get a look in, I'm sorry, and the capabilities that live in your largest state, or largest state for foreign investment, are what's going to drive the future of the Indian economy and investment there. I'm not saying forget about free zones or special economic zones. They clearly have a role, and you need to look no further than the Middle East, and particularly UAE and Dubai, to see what's possible. Now, what's different about UAE and India is that it's a fairly small internal market. It's a staging post for a lot of companies. So the idea of being able to build, assemble, and re-export goods from an SEZ is very compelling. You've got to consider to what extent India is a staging post or an internal attractive market in its own right, as you confront the competitiveness of your SEZs. I'll conclude by saying that, you know, the international perception of India and the clients we speak to who are looking at India are still attracted to its abundant labor force and increasingly knowledge pool of skills, as well as its huge, you know, internal market, its empathy for technology and engineering skills in particular, and the presence of global Indian companies, often family-owned, is extremely attractive for foreign investors. I mean, I have to, you know, go back to my opening remarks that, you know, tax is fairly low down the list of the reasons why foreign companies are interested in India. It may be high up the list on Indian companies trying to improve their competitive advantage into export markets, but I come here just bringing the sort of international perspective rather than the domestic one, so please indulge me with that. I'll be around and happy to take any questions afterwards. Thank you, everyone.
Thank you very much, Mr. Columnist. Now, may I request Mr. Rajiv Chugh?
Good afternoon, everyone. My name is Rajiv Chugh. I'm here to talk to you about, you know, some of my experience in doing over 300 approvals nationally on special economic zones in the country. Just a quick thing, you know, how many of us have already got an existing SEZ unit who are part of the audience? And how many are developers here? Okay. And how many are interested in setting up an SEZ in the near future? Okay, so I think that sets the theme. And we're lucky we've got people from Ministry of Commerce, Mr. Senthil here, and Mr. Majumder, who's been part of the government and obviously can help us lobby. Because my presentation, I was thinking how to start it off. But one point I want to say, sir, SEZs may die in India if fiscal incentives are not continued. Why I make that point is for two reasons. One, and how do I move this? Okay. And I want to take you back to a little bit of history. You know, when in 2004, the SEZ legislation was coming out, actually it was not a new legislation, it was part of the foreign trade policy. It's been there since 1974. But the act came out in 2004, but becoming enacted in 2005. There were some pillars which were built in. The first pillar was a fiscal incentive to be given to the developers and the units. Then the second thing was regulatory freedom. They said, okay, we're going to get into a self-certification, a single window mechanism to allow foreign investment to come in, set up, automatic route, make life easy. So hence, ease of doing business was one of the backbones of how the regulatory freedom was envisaged. The third one was creating supportive infrastructure. They said, you create your SEZ, and also create a supportive infrastructure in terms of having schools, create a walk-to-work culture. And why all these three things were put in together? Because zones, unlike an STPI or Software Technology Park or an EOU, were location-specific. You had to choose an area, go to the area, and create infrastructure. The advantage was there'll be low-cost manufacturing hubs. There'll be employment generators leading to large exports. But having said that, two things have happened in the near future. One, and before I get into the story which is around this and why I use that word, is that today fiscal incentives have been stopped by the Finance Act of 2016. When it was originally envisaged, the aim was to give a tax holiday to the SEZ for 20 years. Then it was dropped down to 15 years, but there was no sunset clause. Finance Act 2016 came in and put in a sunset and said, if you set up an SEZ unit by 31st March 2020, and it should commence production, it'll get a 15-year. But if you set it up on April 1, 2020, there is no tax holiday for you. The developers suffered the fate 2 years earlier, 31st March 17. There was no tax holiday which has been given to them, and suddenly the spurt of the SEZs which had to come in have not happened. So if you do a quick synopsis around this, we've got today 231 operational SEZs. 421 formal approvals are already there in place. If you look at it, there is this gap of 142 yet to go operational. If you look at 231, what have they resulted in for the country? 2 million jobs created. Imagine 2 million jobs with indirect taxation on the salary income that is going to come in is a huge social benefit, sir. So I wish, with the budget now coming in and hopefully in June, July, SEZ tax holidays can be reconsidered and kept in mind that the 200 SEZs can give so much of revenue to you, 4,000 billion. It's a huge amount. So if that can be renewed and extended, that would be an urgent request. So it's time to harness the potential because we've tested it. We know it's good. Let's make it better. If I look at the statewide, distribution of approved SEZs today, there is, Telangana leads it, obviously, in the IT/ITS space. Karnataka, Bangalore, obviously, my colleague alluded to the fact that it's analytical capital of the world. And hence, there is a need to still look at how to harness it. Today, I'm dealing with a lot of captives. NASSCOM says $200 billion worth of work has yet to be outsourced to India. That's the kind of market that exists. If we have to capture it vis-a-vis Philippines and other countries, in fact, of late, we actually are setting up call centers for our clients in Philippines because they are saying we are getting a good English-speaking force there and it's cheaper and the tax holiday is there. So there is work which is going out. US has come back on Jan 1, 2019 with a new law. And they are saying outsourcing, if it exceeds beyond a threshold, they will not allow deduction of that expense to a US multinational. Hence, there is this growing self-control happening nationally in terms of resisting outsourcing. So India needs to create that competitiveness to be able to beat the taxation, to be able to still allow people to outsource work to India. And one more thing I want to highlight, which I've put in here is IT/ITS rules the roast. They were the sunshine, they are the sunshine, they will continue to be the sunshine sector. But other sectors are also slowly coming up. If you look at it, multi-product SEZs are there in the country. That means any manufacturing and services can still be set up. And hence, there is a need to re-incentivize at least the manufacturing SEZs to the extent possible. Now, why is it that, SEZs are good? Any person outsourcing today is looking for a return on investment. If I get a 15-year tax holiday, so the India obviously gives first 5 years as a 100% tax holiday. The balance is 6th to 10th year, you get another 50%. Then for the last 5 years, for reinvestment in new plant and machinery, because they understand technological obsolescence can happen and you need to reinvest in the spaces. But still, India has introduced what is known as a minimum alternate tax on the profits because you're zero tax. So they're saying because you're declaring book profits, not tax profits, you still have to pay what is known as a 18.5% minimum alternate tax. When SEZ as a law came in, this was not there. All this has subsequently happened. And hence, there is a need to revitalize, reboost the SEZ sector by ensuring that these incentives happen. And why I say that, sir, is because, like Mr. Majumder rightly pointed out, if you are exporting services, generally on export of services, there are no taxes because taxes can never be exported. So whether you are in an SEZ or not in an SEZ, still you will be able to claim incentives because you've exported the service. So your input will get, you'll have claim a refund or something for it. The SEZ advantage is you don't pay at source, so there is no cash flow issue. But in the overall perspective, the incentive continues whether I'm in an SEZ or not in an SEZ. Because of the incentives going away, the developers have stopped constructing. I gave that gap of 128, still yet to go operational. So how do we bridge that gap? By still saying, okay, another 5 years, let's give that incentive. Let's make it time-bound, give people an opportunity to re-incentivize and go about doing this. Obviously, there are a lot of incentives my colleagues spoke about, but why still they may survive is because of the upfront exemption. Imagine not paying an 18% GST on your input services. Goods that you're importing today are obviously a BCD, or there's no customs duty on the import of goods. So that's all great. The most other valuable advantage that comes in is, the stamp duty on the land that the developers buy. That is kind of exempted. So 8%, savings on the lease deeds, on the registration cost as an SEZ unit, you don't have to pay that. And obviously, upfront exemptions are there. Obviously, anybody giving an upfront exemption, there are certain issues coming in, and that needs to be addressed, and that have already been highlighted. But what I want to highlight is that the government, and I think the Ministry of Commerce is doing the best it can to promote SEZs, and there are a lot of liberalizations coming in. And one of the key things they have understood and realized, after the financial impact of 2008 and 9 is that certain people had taken large SEZ areas. So they've said, okay, you spare capacity, we'll allow you to lease it out on a shift basis. So imagine you have a shift, so you have a US shift, the day shift is lying vacant, so 9 a.m. to 6 p.m., you can use it on a shift basis. That is enabled. Authorized people working from home are permitted to work. And I will caution all of you, while this guideline has come in the SEZ Act, it has a word, it has to comply with the DOT guidelines. Now, what do the DOT guidelines say? They say that you can only connect if you have what is known as a PPVPN. Now, what does a PPVPN mean? It means a service provider provision virtual network. Now, that is something that does not exist. Your service providers can't give you. So, as such, we have an enabling provision, but the DOT is not been amended. So, you can't do work from home. So, we have an enabling provision, but we also have a disabling provision. So, there's a need to also look at the DOT provision to see how this can be enabled. Setting up disaster recovery centers. Most of my clients in the insurance and on the banking side have to have a BCP site 50 kilometers away from their nearest area. Now, 50 kilometers means if they are in Gurgaon, they need to go to Jaipur. So they can actually set up an unmanned BCP for this purposes, and the law has said it can be manned or unmanned, and still it will be considered proper from a SEZ perspective, which is a great thing. Now, DTS sales by SEZ, there are no export obligations. You can do as much of DTS sales. But there is this one confusion that exists. Services, as defined in the section, say that you have to export services or provide services which are approved services, but you should earn foreign exchange. Now, when I'm supplying services to a person in India, a lot of SEZs have government as their vendors to whom they supply services. Now, the government has to also pay them in foreign exchange, which is not possible. So none of the SEZs today are enabled to render services to government, which is one of the largest consumer of services on Aadhaar and others which are there. It has to go outside the SEZ area. So hence, the definition of services need to be broad-based to say foreign exchange to mean NFE, or link it with the net foreign exchange earnings, rather than saying physically earn foreign exchange and put foreign currency in a bank account in India. And if that can be considered, that will be great, sir. I have 3 minutes, so plenty of time. So something very nice which has happened is, mergers, acquisition, has been a thing which has been happening normally, which is there. So there was this huge thing. If you change the shareholding in a developer or a co-developer, we had a lot of resistance. Why are you changing? Are you trading in your approvals? But there could be a normal change in shareholding because today banks were not giving loans to an SEZ developer because they were considered as real estate business. And in the real estate business, there is a fixed norm of the lending which can happen. So people had to resort to diluting their shareholding. So if the shareholding went above 51%, there was a big cumbersome process of going to the BOA happening, not happening, once in 2 months. There was a huge delay around that. But now the instructions have come in, which are a welcome thing on change in shareholding. And now you can do everything with the approval of the unit approval committee as required. Now, one thing which I have seen happening is that today people are looking at consolidating operations in an SEZ. So a lot of people had set up their software technology parks, a 500 center in sectors 52, 62, 72. Now they're saying SEZs have the best infrastructure available with them. How can we consolidate? So instruction number 70, which came in from the ministry, is a welcome one, which said, yes, you can consolidate in a building. Shift all your STPIs, will allow you to shift, not a problem, but you'll not claim a tax holiday, or you'll claim a tax holiday as per the provision of the law. And that's one thing which is, we are seeing a rush today in terms of people consolidating all the units in one location, taking 500,000 square foot or 200,000 square foot, and ensuring that all the units come in one single large place to enjoy the economies of scale. One thing I just want to highlight to you, and this is something very interesting, is, and obviously because of a time constraint, there has always been this thing that the government said, we'll give you a tax holiday as long as your unit is not formed by splitting up or reconstruction. Now, the word formed means how is it being constructed? When was it born? Whether it was born with existing business, not existing business. CBDT, along with the Rangachari committee, came out with a report which said, we understand that you require old people to tell new people how to do services. So there is always a fair mix which is required. You can't just tell people from the street and say, okay, start working in an SEZ. Who's going to tell them how to teach? So they came back with a circular and recognized that at least 50% of old manpower can form part of the new unit, and still your tax holiday will not be destroyed. Now that obviously gives an avenue for tax planning, but end of the day, what we want to highlight is that if you look at the law the way it is saying if you're investing in new plant and machinery, 80% has to be new. You're taking a new building, you're creating new infrastructure. There is no debar on you claiming a tax holiday. Only thing you need to ensure is that the manpower does not fall breach of that 50% rule. The second thing which happened, and this is something which the big Infosys and TCS came back and said, that we do not maintain unit-wise data points. We look at our enterprise level growth. Today, I'm 1 lakh people, then I'll be 1,20,000 next year. I may have a project in Ahmedabad. Once that banking project is over, I'll have 400 people surplus. I cannot have them sitting on the bench. So what do? Should I fire them, or should I relocate them to another project in Bangalore? Recognizing this, the government in its right option came out with option 2. It says we will not see the manpower criteria at the unit level, we'll see it at the enterprise level. So they will consolidate your total units manpower, see that you've grown by 20,000, so that means you can hire another 20,000 more old people and you can set up a new unit. So if I take you to this example, I have an opening balance of 10,000, I add 2,000, I transfer 3,000. Now 3,000 is more than the 2,000 I've added during the year. If I had followed option 1, which was looking at only at the unit, the tax holiday would not be available. The moment I look at the enterprise level growth, that I have totally added 4,000 or 2,000 people, my closing balance is 2,000, means I can add another 2,000. So the unit size can be 4,000, and hence it is more than 1,500 that I've added, and the tax holiday would be available. So this is a little bit of a mathematical analysis that can be done to ensure that the tax holidays continue, and you're able to sustain this. 2 small points, and I'll just take 1 minute more, sir. And this is something which is there. We spoke about operational issues. Sir, the SEZs today are looking at moving very fast. The agility at which they want their approvals to happen, you have an instruction that the LOA should be issued within a period of 7 days. The bond cum LUT should come within a period of 15 days. We would request if these procedures and timelines can be adhered to so that it makes ease of doing business even better. The zero rating, which was already talking about supply. So suppose I render a service to an SEZ unit. I may have an invoice of 5 rupees, 10 rupees, 100 rupees, 1,000 rupees, 1,000 invoices. I need to go to a authorized officer to getting it endorsed. Imagine the complexity and the compliance requirement that has come in. And what we want to suggest to you, sir, is that today SEZs have to take a mandatory registration under the GST regime. Because they are registered, obviously any input invoices and the vendor linking the GST should become the norm for the purposes of giving these endorsements rather than getting a physical stamp on this thing. And this online thing can be taken care. That will be great. And thank you all for your patience. And if, in case there are any questions, then we'll address it later. Thank you so much.
Thank you, Mr. Chugh. You have done excellent, and all the three speakers have done. Now, the last but not the least, as they say, Mr. Bimal Jain. Please.
Good afternoon to all the panelists, chairman, ladies and gentlemen. Good morning once again and good afternoon once again. Are we all alive? Yes. I was seeing that SEZ presentation was going on, and I've seen that number of guys were on their mobile, sending messages here and there. So I thought of, no, I will not give PowerPoint presentation. I will change my presentation from your perspective. I've seen the hands up for the SEZ unit and SEZ developer, and there are many those who are looking for what is this export and SEZ we are talking about. I can tell you in simple one line, if we talk about SEZ and export, what need to be done in any country, including India, whatever taxes is being charged should not be exported. Am I right? Are we getting the similar benefit? Let me take the challenges one after another, and I want you should participate with me. I want this should be your presentation. Maybe I will take 3 issues or 4 issues within the time frame given to me, but I want you should come back to me. The first one, I'm a supplier. I'm supplying goods or services to SEZ unit. I have 2 options. I can supply on payment of IGST, and I can take disclaimer and go for refund. Or I can export, I can supply to SEZ unit or developer without payment on the basis I have executed my LUT. Am I right? Tell me which option you'd be looking for. IGST or without payment? Without payment, right? Look at the problem now. If I'm a supplier and you want me to supply without payment, then what is the problem coming to me as on date? Let's say I got my 50 rupees inward supply and 18% GST rate applicable. So 6 rupees on input, 1 rupees on input services, and 2 rupees on capital goods. So 9 rupees ITC lying with me. If I export to you at 100 rupees and 18% applicable, so IGST would be 18 rupees, am I right? Then I will be allowed to adjust my 9 rupees ITC and I will pay 9 rupees in cash, but I will get 18 rupees back as my rebate or refund. But if you ask me to supply without payment, then what happened? I got 9 rupees ITC, am I right? Will I be allowed to get 9 rupees refund from the government? 2 rupees capital goods credit is being denied in my hands when I supply without payment of IGST. Are you listening? So when same parameter, export or supplies to SEZ unit are 0 rated, either it is made on IGST or made without payment of IGST, why there is a disparity for capital goods credit? And why such supplier would be willing to supply on without payment option? First, law need to be checked in. Second option, second critical issues. Let's say I'm having head office in Delhi. Head office in Delhi. I got my branch in US. We are talking about IT and ITES, right? Such a big sector as on date, exporting services. Head office in Delhi, US is my branch. My branch got client in US. Now they want to serve to the client, but they're not having enough manpower they requested HO Delhi to serve to the client in US. So I'm going, at the instance of my branch, US branch, serving to the client in US. So I'm going to raise my invoice to my branch in US, am I right? And branch is going to raise the invoice to client in US, am I right? Tell me whether my service, HO service to branch, is export of service. Please, apply your mind and say yes or no. It is not export. It is not export. What are the export of services provisions are? Supplier must be in India. Recipient must be outside India. You must have received money in convertible foreign exchange. Place of supply must be outside India, but you should not be merely establishment of distinct person. So HO and branch becomes merely establishment of distinct person, even though services rendered for client outside India got paid in convertible foreign exchange, it is not export of services. Reverse case, let's assume reverse case, you're taking services from branch US to HO in India. It is not export when I talked about export. What happened reverse case? You're taking services from your branch in US. HO is taking. Whether reverse charge applicable? Answer is yes. So it is not export on one hand, but reverse charge applicable. Third case, critical case. Let's say I'm a commission agent in India, in Delhi. The foreign supplier, let's say in Korea, requested Bimal Jain, Mr. Jain, can you find out Indian market for me? I have found out the market for my foreign supplier, identified the customers. Now this foreign supplier sitting in Korea supplying goods directly to the customer in India. Am I right? And they are clearing the goods by filing bill of entry. I'm being paid a commission by whatever name called. Whether that is export of service, because I have given this service to my foreign supplier, is it export of service? Say yes or no. It is not export of service. And this provision applicable from 1st October 2014, this provision got changed in service tax era and copy-pasted in GST regime. Okay, just listen. Look at the interesting part. Time is short, that's the reason I'm running fast. It is not export. I will charge 18%. Who will bear this 18%? My foreign supplier will not get any credit. I become incompetitive. I will give my business to Bangladesh, Nepal, Pakistan, and Bhutan. This is one case. Look at the reverse case, Let's say I'm in Korea. I'm a foreign commission agent. Now, Indian supplier wanted to get market in Korea. Am I clear? So I'm in Korea. I'm identifying customer base in Korea for Indian supplier. Now, this Indian supplier is giving me some amount, say commission, with a reverse charge applicable. Reverse charge, you understand. You have taken services from a supplier outside. Reverse charge applicable. No reverse charge. So first case, you are earning foreign exchange for country India. GST applicable. Second case, foreign exchange going out of the country. Reverse charge, not applicable. Coming to the fourth case. Maybe I will take two more, sir, within 7 minutes. Two more cases. We were talking about SEIS and MEIS script. Am I right? Advantage. What is advantage? You can use such credit script for payment of basic custom duty. Am I right? And it is transferable from me to you. I can sell. Any GST implication? Any GST implication? What is? Initially it was 12% taxable, later made 5%, then later made nil. Nil is exempted. And once it is exempted, repercussion of reversal of ITC, input tax credit on exempted will come. So what advantage we are giving when we are talking about export? SEIS and MEIS, it should be taken out from exempted list so as I'm not required to reverse credit. Come to the fifth one. Now let's look at the broader aspects. Sir, here I want to invite your attention also and all the panelists here. What is the objective of Make in India? Promote Make in India, am I right? I need your attention. Maybe 2 minutes you can listen to me and get a broader perspective why I'm raising this point. Our Honorable Prime Minister has said, make in India, as against import of goods, right? And you have recently seen the Balakot issue and the China not supporting our contention, and we started shouting, stop Chinese import. Am I right? Now look at the irony of this country today. I just want you to take to pre-GST era. When we were importing goods, we were paying basic custom duty, CVD, custom cess, and SAT. Am I right? And if you're a manufacturer, then you're allowed to avail credit of CVD and SAT. If you're a trader of imported goods, you're allowed only SAT refund. That too specified goods. And if you're a service provider, you're allowed to avail credit of CVD only, right? This was the pre-GST. From 1st February 2018, what is the structure now? Basic custom duty, social welfare surcharge, IGST, and compensation cess if leviable. Now look at the difference between manufacturer and the trader of imported goods. Now, if I'm a manufacturer and my friend is importer of same goods and trading in such goods in India, we both are getting the same advantage. We will pay basic custom duty, social welfare surcharge, IGST, and IGST credit available to both of us together. But pre-GST, trader of imported goods was allowed SAT refund only 4%, as against CVD and SAT credit in the hands of manufacturer. So manufacturer was protected against import of goods. So what happened? Are we really supporting Make in India? Coming to the last conclusion point, I will not extend further. We are talking about SEZ, global economic zone, export, import. Time is paused for me, but only the thin line which I want to draw here. We have seen in recent time getting refund from the department side. And I posted a query whether if I'm looking for supply, and that to SEZ unit, you would be preferring to get without payment, but supplier is at disadvantage not to get refund of capital goods, right? Why we create such disparity? Why such confusion? Coming to the advance ruling, one advance ruling only, one advance ruling. You are SEZ unit in Delhi. You come to my Le Méridien hotel, let's say Asoka hotel, this is my hotel, and you take accommodation services. Tell me GST applicable. As per law, if supply made to SEZ unit, it should be 0 rated. Am I right? Say yes or no. 0 rated. So whether it is 0 rated or taxable? Tell me, 0 rated or taxable? 0 rated, but advanced ruling has concluded, no, it is not 0 rated. It is taxable. And second question, whether this should be intrastate or interstate. Tell me, intra or inter? I'm in Delhi, Asoka Hotel in Delhi. You have come to my hotel availing services, intra or inter? It can't be intra. Section 7 is the Bible of IGST Act, talks about any supply to SEZ unit or developer, it's an interstate supply. What advanced ruling concluded? It would be intrastate. And then try to understand, advanced ruling authority going extra mile and concluding something which is not as per the law, a circular comes out and say, no, advanced ruling authority, you made mistake. It is 0 rated and interstate, overruling the advanced ruling judgment without appellate authority decides. So litigations are pipping up. What is authorized operation? I'm a SEZ unit. Whatever input service I'm taking, it is meant for my authorized operation. I cannot offer coffee and tea in my operation unless you work in SEZ unit. It is my customary process. I need to offer it to you and should be used for my authorized operation. You can't be. There are 66 services. We talk about known services for authorized operation. And that endorsement from the officer, it is creating boil water in our minds. I can only say with one last line to sum up my presentation. My other colleagues have said SEZ benefit and advantage. I started with the critical issues. I could have carried on giving 10 more. Time is a porch. But it is not in my interest to criticize. It is only constructive suggestions. To whom? To the government. Make it really ease of business for the objective of providing ease of business. Let export prosper. And export will prosper only when tax implications are taken away. Taxes should not be exported. So with this, let me say thanks to each one of you for giving patient listening. Thank you very much.
Thank you, Mr. Bimal Jain. The perceptions of the persons actually involved in SEZ, that has been well expressed. Now we are waiting for Mr. Senthil Nathan, because he is the Deputy Secretary in the Ministry of Commerce and Industry. So I would request him to take up the issues which have been, the important issues which have been raised here, and give your comments. And I can mention here, we started 20 minutes late, so we can take some more time, okay? The session is quite interesting. If you feel hungry, you tell me, then we'll close it. Okay? Please, Ken.
Respected chairman, and he is chairman to me in more ways than one. He has been my senior in my parent cadre in revenue service. And distinguished panelists and my dear friends, ladies and gentlemen. I stand at a place where I have to deliver a lot of answers. A lot of questions has been put. And I also stand at a place where I stop you from lunch for some more minutes. So bear with me while I try to answer at least some of the questions that have been raised. One issue is very clear. SEZs, as they have been conceptualized, they had their birth in the foreign trade policy, and thereafter they have been carved out as a separate act. They have been brought with a framework to make India leverage its potential for exports. Have they served that purpose? Yes. That, I think, is a very clear answer. But have they served that purpose to the potential that it was possible? I would initiate the answer, no. Definitely there is a much larger potential that is possible. Because when it was started in all that exuberance of SEZ Act, if you had seen the growth of exports in SEZs, it was sometime even touching triple digits, and even 40% or something a year later. And if I have to side with some of the panelists and say that since we are talking about tax incentives per se, there was a bit of a bait and switch, which resulted in a lot of disappointments. And the tax structure changed, and resultant MAT and other direct tax benefits which have been curtailed in terms of the time frames, both for the developers and for the units, have resulted in a kind of a break, a pause in the growth rate. We have been growing nevertheless. These have been taken in the larger structure of the taxation reforms that have been happening, and some part of the collateral damage has happened with the SEZs also. But from what we see as Ministry of Commerce, we have been trying to promote and try to sustain some of these incentives which had been available and which is having like a ticking countdown that's happening. And we have been taking it up very strongly with the Department of Revenues. Of course, they have their reasons for making change in their tax structure. But this is an ongoing process, and we are hopeful that we might find some kind of a, if not a permanent solution, at least something, an encouraging solution for this tax question. So I wouldn't want to go further in that, but these are ongoing efforts. But things as they stand today, this year, this financial, SEZs are likely to cross $100 billion in exports. And that's about slightly less than a third of total exports of the country. This shows like what kind of a growth engine that SEZs are presently. And to further expand this context, as Mr. Chugh and others have been pointing out, this export growth in SEZs have been concentrated largely to the southern states, maybe at Maharashtra, Gujarat, and a bit of Gurgaon and Noida also. So if you take that, you're covering almost 80% of exports in SEZs. Plus, if you see the sector-wise allocation also, it has been a largely IT-ITES story with some elements of maybe multi-products where auto and others have come in. But petroleum, again, is a very big part of it. So we need to expand both the base geographically and also the kind of SEZs that we are having, while not discouraging IT-ITES, because we as a country have a leverage in how we are placed and how we can kind of leverage upon our knowledge and IT skills to deliver more and more in terms of export income. But at the same time, I am sure most, if not all of you, would be aware that there has been a recent study which has been commissioned by the Commerce Ministry, which has been under Baba Kalyani. He is MD of Bharat Forge, and the report has also been submitted. So the thrust of this report has been to expand the scope of manufacturing activities within SEZ. This, especially from what Mr. Connell has said. We understand that globally, most investments are in the region of tech and services sector. But at the same time, when we envision India as a $5 trillion economy going within 5, 6, 7 years, we expect manufacturing to grow at least to $1 trillion, contributing to this GDP, while $3 trillion will still be services growth. So we need to expand manufacturing, and SEZs do offer a potential for expanding this manufacturing base of this country. We have a large and thriving market within the country, and we can still serve as a large manufacturing hub for exports also. How do we go about this? We have challenges. Tax incentives, as Mr. Connell was saying, are an important aspect, but not right at the top of any investment decision. This is recognized even in the report that I was referring to. We need to build a lot of enablers around SEZs. How do we do that? One is about making ease of doing business in terms of regulatory framework, in terms of what are all the compliance requirements that are presently required to make them even more efficient and even more simpler. We are already have taken a lot of steps in that direction. We already have an online platform which was mostly manually driven. SEZ compliances have been put in an online platform, and shortly we will also be integrating in terms of payment with the customs ice gate network, which is going to happen within a quarter or so. And we are also trying to delegate most of this work. We have envisioned SEZ as a single window clearance, but anyone who has been working with SEZ either on the compliance side in consultancy or even SEZ developers units, they would know that this is not exactly a single window till date. Large movements have happened there, but we still have to go further. So we are trying to move in that direction, trying to make a lot of compliances by automatic declarations, a lot of compliances in terms of the unit approval committee with the development commissioner itself, such that you don't need to come for board of approval. And of late, there has been an improvement there also. I think Mr. Chugh and others might agree that we have been having board of approvals once in 2-3 months, but now we don't actually have so many proposals to consider for the board of approval. So we have done quite a lot of stretch there also. So we are up to date there. So we are trying to have it once in a month so that we don't have investment proposals waiting for approval from the board. But at the same time, we also are considering a more free flow of ideas, free flow of an attitudinal ease of approving also, in the sense not so much of questioning what exactly could be the intentions for these kind of proposals. So I don't want to take a lot of time. I'll just try to broadly touch upon some of the issues that have been raised. A lot of issues have been raised upon GST, some compliances, especially the endorsement that has been a major pain point. We are working on that, and we have already received some kind of proposals on that. I would request my panelists also to give us. So we would try to ease this with the Department of Revenue, because in SEZs, it's not just Department of Commerce, baby. We actively interact and interface with the Department of Revenue because there's a lot of laws of revenue issues that Department of Revenue has to be taken board of. So we actively interact with them. We will definitely try and find a solution for this. We would be happy to see some proposals in this direction. Plus, already we have made some amendments to Rule 53, which talks about NFE criteria, where a lot of difficulties were faced when there was an earlier amendment. That also has been done, and in February we have already notified the rules in the new form, and part of the notification also addresses the work from home requirements, which I think has eased all concerns on that direction. With respect to some of the advanced ruling and other GST related issues, we have already taken up these issues with the Department of Revenue, and we are hoping, because GST, as you all know, is something, a game-changing kind of a tax reform that has happened, but we should also recognize, while it has provided a lot of positives, before GST, we would not even be able to assess how much is the taxes that have been consumed in an exported product or a service, much less refund them in time. That's a different question altogether. But after GST, if not 100% of the taxes, 95% of the taxes, we are able to assess what exactly has gone into the exported product, and we are able to refund them at a much more efficient way than the pre-GST time. It is still a baby. It's a 2-year-old baby. So I think we should have patience with that. Just we have our own babies. We have patience with them. I'm sure they are much more responsive. And I'm sure GST has proven to be a very, very responsive tax structure, as compared to the earlier times where you had a central administration administering a set of taxes and a state administration administering a set of taxes. GST Council meets regularly, and it takes on board multiple issues from across sectors, and they do provide solutions. So I'm sure these issues that have been flagged, we are already aware of some of them. I have taken note of the others. We will flag it to our friends in the Department of Revenue and the GST Council also. And I'm sure going forward, we will see positive resolutions. Most of these procedural issues and also tax issues like refund and place of supply issues Mr. Jain had raised. Going forward, once we are through this election cycles are over, we hope to see more and more easing in terms of recommendations that we have received with the Baba Kalyani report. And we have already taken it up with the Department of Revenue. We have had initial consultations with the Revenue. And I'm sure what we are seeing is we need to encourage SEZs in terms of development as well as units that are functioning there in becoming engines of growth of export, as well as ease their interactions with the domestic tariff area. There is a tax concerns, like what you give as tax incentive should not be flowing out to domestic supplies. That is definitely there. We would have to have some safeguards for that. I don't want to go into the technical details. We are working on that also. But going forward, we want to ensure that these tax concerns are addressed in terms of procedural issues which are solved, as well as we are looking at providing more enabling framework for either having more access to infrastructure that help exports happen, more ease of movement in entry into and outside the SEZs, because these are things which are important to attract investment, both domestic and foreign, into SEZs. And we are sure that going forward, SEZs will power the engine of India's growth in a much more bigger and much more momentum-giving manner. And with these few words, I would like to conclude, and I wouldn't want to stop you from your lunch. Thank you very much. Thank you for all the panelists for their points. And I hope to answer some of your questions in the crowd also. Thank you.
Thank you very much, Mr. Senthil Nathan. Your words are very reassuring, and you have taken very painstakingly all the points which have been raised, and some of the points you have already covered, and some you have said. And as you rightly said, like I always say that GST is a work in progress. Similarly, your SEZ work also, it's going on for a long time. But with the feedback from the participants, all the stakeholders, always a improvement is there. And I'm sure the points raised today by all the speakers, and we have got an international flavor also, that you have known all the issues that he had raised, Mr. Kunal had raised, and all of us. So thank you very much that it will It will get the direct attention of the Commerce Ministry, and I'm sure you are in coordination with the Revenue Department, and that sort of things will be sorted out. We are quite late, but still, for question and answer, I'll just 1 minute. I would say that already we are 24 minutes beyond 1 o'clock. So what I suggest is that most of the questions, whatever you have, you please have it offline, and also during the lunchtime. But 2 questions, perhaps we can manage, just 2 questions. Okay. Only 2 questions we'll take, and after that, yes.
Sir, NSDL is maintaining that the
Your question is to whom?
Mr. Senthil.
Okay.
Sir, NSDL is maintaining the SEZ online systems. The first thing is this, why the manual, we are still submitting that manual information to the Development Commissioner Office. First reason is this, that NSDL doesn't have the proper bandwidth or that storage spaces. So that government is, Development Commission is asking that information. Second thing, that NSDL is providing a zero-rated services to the SEZ units. And as per the GST law, the SEZ endorsement is not required on the services invoices when it is coming for the zero-rated, not for the tax-paid invoices, because they are not taking the refund. But what they are insisting us, and they have sent mail to all the units, that you will have to endorse with the specified officer. So the question is this, that when the law doesn't require, then why it is required to do? But what their argument is there, that they wanted to take the input credit refund from the GST departments, and the GST department is telling them that you have to get it endorsed from the NSDL. I have raised the question, when you don't have the system of putting the SEZ invoices in the SEZ online
Place
system.
the question, let him respond.
So please, do that things.
Yeah, this question has already come to us, and we have taken it up with the NSDL also. And as I told you, the endorsing of invoices is a larger issue, not just for NSDL. And definitely we are coming out with some kind of a solution for this, which would not require like endorsing each and every invoice, and where they are not required in the first place to be endorsed. So definitely that we would definitely say that we will clarify in the same communication. Where it is not required, it should not be done. So that would, I think, ease your problems. Thank you.
Thank you. Yeah.
I'm Siddharth Sen. I'm operating as a unit in several, as an FTWZ unit in several SEZs and FTWZs all over India. And I would like to just, pose one question, which I would like to continue while discussing in the lunch. I don't want to, it is a big thing. I have done about, under 18.5 of SEZ rules, I have done exports of approximately 700 crores in this fiscal. And I have found that lot of, yesterday also I put this point before Mr. Swain, that I'm having tremendous difficulties in having drawback and MEIS for my clients for whom they have service. That is one. Number 2 is applicability of GST for services rendered by me inside the FTWZ, which it's all difficulties what is resulting, this entire activity of economic activity of finance, trading, logistics, manufacturing, and then which is taking place for goods which are supplied to India from Dubai or from China or Hong Kong or Singapore. It can now, the whole hub, it can become India by doing it inside the FTWZ under 18.5 and 18.6. It is a long drawn out process. Yesterday I requested your senior. He has told me that I could come and talk to you one-to-one and address this problem. And also,
respond then.
Yeah.
FTWZ issues are like, both the issues that you have raised are known to us. And with respect to the first issue that you have raised, that's about the drawback and MEIS. This issue is already under discussion with the DGFT. And shortly we will be coming out with some kind of a communication on this also, where we would try to set a procedure for enabling availment of these benefits for units there. With respect to your applicability of GST wala question, this is an issue which has been created because of the way the place of supply rules have been framed under the GST law. And in the context of FTWZ, this makes it as if that these are not amounting to export of service, even though you might be getting income in foreign exchange. So this has also been taken, and we have already apprised the GST Council and the Secretariat in the CBIC about this. They are aware of this, and we are hopeful that this would be taken up in the forthcoming GST Council meetings, and we should get a positive solution on this.
Thank you.
Thank you very much for that. Thank you.
I may add here what Mr. Senthil said. See, this place of supply of services rules, these are very, the intention is to clarify certain matters by using proxies. Like, in certain situation it is described that in this situation, this will be the place of supply. If you go by the normal norms and normal laws, perhaps this will not be. But by putting that proxy, the things are simplified. But in some cases, it has complicated the matter. So again, as I said, this GST implementation, always it has to be two-way dialogue between the stakeholders and the taxman, and I'm sure the things will be taken care of.
One point about
Very
this
short, be very short.
Section
We are
51,
yeah.
the overriding effect of SEZ Act. That I would like you to consider also. And we will discuss it later on, no problem. I mean, we will discuss it because...
Thank you. So we close it now. Thank you very much for your patience. I hope you will be benefited by this session, and all our addresses and other things will be there and through the organization. If you have any further query offline, you can get in touch with the speaker. I'm sure the speakers will be happy to respond to you. Thank you very much. Thank you to all the speakers. They've done a wonderful job and made my job very simple. I didn't have to talk much on this thing.
Thank you to Chairman as well.
Thank you. That concludes a very enthusiastic talk. Thank you to all of our panelists and the audience. I'd invite the Honorable Chair to felicitate all the speakers. We can start from the left. Mr. Rajiv Chugh. Speak. Mr. Baskar K. Mr. Senthil Nathan S. Mr. Mark O'Connell. And Mr. Bimal Jain. I now invite the Exhibitions India Group Chairman, Mr. Prem Bahl, to felicitate the Honorable Chair.
Ladies and gentlemen, as usual, I must have the last word. Isn't that so? Having said that, I'd like to actually commend this panel for a very interesting session. I thought it was incredibly useful from the point of view of some of the difficulties that are being experienced, not some, many of the difficulties. And in my opinion, and this is something which has been articulated also by the chairman of the session as well as by Mr. Senthil Nathan, I think the mindset of the administration is undergoing a sea change. And having said that, the past difficulties that one has been experiencing are somewhat being mitigated, may not be as swiftly as we want. But actual thought and process is being undertaken. So while there are difficulties at this particular point of time, be rest assured that 3 months later, the administration will be up and running again very rapidly. It's just we're now in a hiatus of time, but be rest assured that whichever administration comes into power or becomes the lead, you will get direct access and redress very, very swiftly. This is the new India. This is the new dawn and the new era. So be confident that you will be well served. Thank you. And with that, I must compliment the chair and offer him my felicitations as well.